Hey, welcome back, everyone. It is time for another red-hot covered call car session podcast. I'm on the road. I want to talk covered calls. Well, hey, look, we are on the road, and we are going to talk covered calls. You know, recently the stock market has just been getting kicked in the ribs, and yesterday the market was down some 900 points. I'll tell you what, my opinion, they run them up to sell them off to run them up again. Now, how do we profit from that? That's what we're going to talk about today. If anything, we're going to talk about how we can mitigate some losses or deal with it, right? We all experience this. We're buying stocks in an upward trending market, and Wall Street pulls the ripcord, leaving us holding the bag. I mean, Facebook was down some 20 points yesterday, and I know a lot of you out there are buying Facebook, writing covered calls. So how do you deal with that? Well, I'm going to try to share with you how I profit in a falling stock market, but how I also try to mitigate some losses. So if you sit back and just soak it in, right? Now, my unedited podcasts generally go about 20 minutes. So grab yourself a cup of coffee, kick back, and if it's too much for you in one round, pause the video and come back and listen to the rest. I promise I'm going to share with you some stories and experiences that are going to up your game. Now, look, if this is the first time you've ever been to my channel and you're looking for a red hot video, well, I'm just not going to be able to do one this week, but I want to get something out to you. You know, I get a lot of feedback on Facebook where I have my Facebook group, CTP Dashboard. Go there, follow it. You get to see all the stuff I'm posting and we get to talk about it. Well, a lot of you find yourself in a tough spot. And quite frankly, I'm in that same spot. We bought stocks, markets are tanking. Well, what do we do? So we're going to talk about that today. But look, before I get going, I want you to, if you like what you're hearing today, I want you to subscribe to the channel. It's free. I want you to come back. We do this every week, trying to up your game. I never charge you nothing. All I do is share my experiences and share trades with you. So maybe it gets you comfortable. Maybe it ups your game. And hey, look, if you like this podcast today, bang that like button. It lets me know you like what I'm doing. Now, what I'm doing is this. We are on the road. We are talking covered calls. Let's talk about this stock market. Now, I'll tell you, I believe that they run them up to sell them off. We are now in an era where the markets are so high, the numbers are so big, it makes headlines when the market's down a mere 1%, 2%. Why? Because there was a day when the stock market was up, the Dow was up 100 points, that would make the news. Now, the Dow is up so big, the numbers are so big, you know, you see these headlines where the Dow is crashing down 800, 900 points. Now, hey, look, the Dow and the S&P should not be running up and selling off some 3%, but we are in that area of the market where it is fluffy. You know, right now Wall Street is not jamming their money into properties. They're not jamming their money into bonds, treasury notes. There's just no money there. So what do? They jam it into stocks and they run them up because there's demand. There's more buyers than sellers. And market makers run these things up. So we are at all-time highs. We're at all-time high. We're just over the halfway mark, and we've hit all-time highs twice this year, and we've sold off more than what they consider as a correction twice. So this is how it works. You have to wrap your head around the idea that they run them up to sell them off to run them up. Now, some of you don't believe that. And unfortunately, some of you will bang that dislike button because you think that's tinfoil hat stuff. Just look at the charts. They run them up, and then they get that news event that's nothing more than a news event. It doesn't move the needle, but yet it does. It does move the needle because Wall Street sells them off. Because nowadays, computers sell. And hey, they take profits in pennies, okay? don't think of it like, oh, well, they might be holding on in the hopes of, no, they pull the ripcord because they know they'll take profits because tomorrow's another day, another opportunity to make profits. It's just the way it is. And you have to understand that Wall Street will buy stocks, then they have other departments that write covered calls, sell cash secure puts. Look, it's not like you and me. It's not like we buy a stock and we're invested, right? We have a hard-earned money into this. We're emotionally into this. We sell that covered call, right? Well, no. For them, man, it is computers and they're making money up or down. So for them, they make money in pennies. So they are going to pull it. You got to be able to handle that emotionally, and you have to have a plan. You have to execute the plan. So let's talk about how we can benefit in a falling stock market. Now, look, at the end of the day, we write covered calls and we hope to buy stocks that trade sideways to up because we want to give somebody the right to buy our shares at a higher price. We get a premium for that and we give them a certain amount of time. Now, we can make some nice cash on cash monthly profits, and we do. But when the markets are tanking, nobody's buying calls. Nobody's gonna buy your covered call for a good juicy price. So at the end of the day, we're stuck because we buy a stock in a market that's going higher, but boy, they sell them off with vengeance. So usually what happens is we buy the stock and we write the covered call. Well, the stock falls more than our stock purchase price. So we're left holding the bag. So if you're like me, you buy the option back, but now you own a stock that's below your stock purchase price, and the next strike price you write with any sort of premium is below your stock purchase price. Well, you don't want to do that. I mean, particularly if you're not an experienced trader with limited exit strategy experience, you don't want to give your shares away at a loss. So you're there sitting on your hands. And I've told you, man, I don't want to sit on my hands. That's why I always tell you, have a plan, execute the plan. Now, when the markets tank, sometimes the plan is to sit on your hands. Now, I hate that, but we have to. And sometimes the plan is to pull the ripcord. Have the discipline to sell a stock that falls further than what you can afford. I hate to say that, but I'm the guy that's going to tell you got to have discipline, because I have sat on my hands and watched oil stocks tank by half and emotionally get ripped. So if you're going to enter this game, any investment game, okay, you got to have a plan, got to execute the plan, and you got to be emotionally prepared. Okay? Some of you cats email me saying, oh, I bought this stock, I'm down 2 points, what should I do? And the stock's a $200 stock. I mean, 2 points doesn't even move the radar. So you got to be emotionally in this. How do you do that? Well, you get your experience. I'll give you a quick story before we move on. Jim Brown, the greatest running back ever, right? And I'm not even a Browns fan, man. I'm a Steelers fan. Greatest running back ever, always scored a touchdown, flipped the football to the ref, and just walked back to the sideline. Never celebrated. And they asked him, why do you do that? And he said, hey, got to act like you've been there before. And that's how you should be dealing with this stock market. Act like you've been there before, make good decisions, and the way you get there is by getting your experience. Now, with that said, let's talk about how I benefit from a falling stock market. Maybe I can give you some ideas here. Maybe you can use them in your game. Well, just yesterday the markets fell some 700 points. What did I do? Well, first of all, I have been doing my homework. I have my list, and I check it twice. And I have my wish list. Because when markets are at all-time highs, you know they're going to sell them off, or at least that's what I believe. And when they sell them off, I need to be ready. I can't tell you how many times I have written emails to all my buddies, and told them this, told them that, and I wasn't ready when the markets did fall. Either I didn't have cash on the sidelines, or I wasn't prepared to act. I wasn't confident. So for me, I prepare for the down days, even though we're hitting all-time highs. So just recently, within the past week, I've been doing some research on 3M. Recently, I bought 3M, wrote a covered call, collected a fat dividend, but my shares were taken away. So I want to own 3M again. And the stock recently hit 177. Well, now it's trading back at 165. So I wanted to do my homework, because when the markets sell off, I want to be able to buy it again. But I got to be ready. So have your list. So I have my list. So what did I do? One of the things I did yesterday, and I was eyeballing it for a couple weeks, and I was looking at a 5-month cash secure put on WIN. I'll be honest, it was WIN, but I ended up doing it on the TQs, the 3X leveraged ETF of the NASDAQ. I was going to do this on WIN. I looked at a cash secure put, and at the money cash secure put, because what I'm thinking is, look, if I'm going to believe and buy into the fact that Wall Street buys them up to sell them off, when they sell them off, I got to believe it's going to go higher, right? So for me, this is not the end of the world. This is just a news event for which eventually they're going to buy them up. So that's what I did. Yesterday, I was looking at a 5-month January 2020 cash secure put on the TQs. At the money, paid me $9.10. So, look, I've never done this before, but I'm thinking to myself, I'll do at least 100 shares. Because I'm thinking this is a great opportunity to pocket a quick cash secure put, a deep premium cash secure put. So I'm going to get paid $9. Now, if the markets were to bounce, now I'm not saying they're going to bounce today, tomorrow, the next week, but I've given myself 5 months. So I set aside $55 a share, $5,500 for 5 months, and somebody out there paid me $9.10 per share, $910 up front. That is 17% for a 5-month trade, cash on cash. So that's what? 36% annualized? Just to set aside $5,500 for 5 months. Now, I do this trade because I believe the downside on the TQs is around 51. Where do I get that number? Did I just pull that out of my rear end? No. I looked at the capitulated selling that happened in late 2018 as my barometer. Okay? Again, doing my homework. I'm not going to say I'm a chart expert, but when you look at that support line and where it broke support and then bounced, I'm thinking if anything, Wall Street will use that 51 on the TQs as support if all hell breaks loose. And quite frankly, if this market keeps selling, what? They assigned me the TQs at 55 in January and paid me $9, so my real cost basis is 45, which is $6 under the support line. So the idea here is I'm going to use this short-term volatility for some short-term profits. So that's what I did. Went ahead, sold that cash secure put, and now I'm going to wait. Gives me 5 months to wait, but I'm going to wait. And now when the markets rebound, TQs is going to bounce from 54, 55. It's going to go back to 64, 65. And that $9 option they paid me, because it's moving away from the 55 strike, is going to reduce, right? So depending on where I want to be in the trade, I will buy that option back long before January 2020. Now, whether that happens or not, that's to be seen, right? But here's the point. The point is I got a plan, I execute the plan. I didn't just dial that trade up willy-nilly. Because this is when we want to make good decisions. Because many times people will stick it in. To be honest with you, I stuck it in last Friday. The markets had sold off, and I actually thought that was a nice little short-term sell-off, so I bought an extra 100 shares of Chevron. Chevron had fallen from 125. They had great earnings, going to distribute a dividend. It fell to 121. So what I do? I bought 100 shares of Chevron, and I wrote a covered call. Well, I could have bought Chevron yesterday below 118. So even having a good plan doesn't mean everything's going to work out for you. So again, it goes back to being emotionally prepared, having a plan, executing the plan. So how do we profit from this? Well, I've told you, in fact, I think I told you this in the last video I did. In fact, watch my last video. Towards the end, I talk about how I use earnings reports, which we don't want to use, right? We don't want to write covered calls through earnings reports, but I showed you how I will use earnings reports to generate some premium while I'm holding the shares that I'm holding. So that's what I did. I wrote a covered call as the markets are falling, knowing that they're going to fall. That's what I did with Chevron just last Friday. So I wrote that covered call, hoping the market would go higher. I mean, I'm hoping, right? But if it fell, I would buy it back. And that's where I'm at right now. That option, I think I got paid $1 something for it. It fell down to 70 cents. Now, it didn't fall down to my number for which I buy back options, but I'm watching it. And if it does, I buy it back. We sit on our hands for a little bit. Hopefully we get a green day or two and I can write a call. Now, my cost basis on Chevron's higher than the stock purchase price, where the stock's trading right now, but for some of you, that's not the case. So what do we do? Well, here's the deal. What can we do? Obvious. It's super obvious. If you have cash on the sidelines, you bought a stock at 100, the market has now fallen, right? You could buy more shares. No, you don't want to hear that? This is a selling premiums YouTube channel. How does that help us? Well, it reduces our cost basis. So now we can then write a covered call above our strike price or at our stock purchase price. Now, that doesn't make for a trade that is profitable to write home about, but sometimes you're just looking to get out of the trade, man. Sometimes you're just looking to get a green trade. Now, you could sit on your hands and wait. And if you truly believe this market is going to sell off and then rally, then you sit on your hands. Now, if your exit strategies are in place and you know how to buy back your options, then you already know what I'm going to tell you. You can dance with the devil and write covered calls for strikes that are below your strike price, your stock purchase price, and buy them back, possibly adding to your cost basis. We know this, right? When the stock goes above your strike price, usually it's a rare bird that buying back the option is less than what you got paid. Most of the time, it's more expensive than what you got paid. So you're going to add all of that added premium to your cost basis. But here's the deal. You'll roll up. You'll buy it back, adding to your cost basis, but then you'll roll up selling a covered call, writing a covered call for the next strike, collecting more premium. Now look, that's where you need your calculators. I'm going to tell you right now, whether you download my free spreadsheets or get your own, you need to have spreadsheets because you have to keep the numbers in front of you. Because when you're doing this, you have to know when you're profitable. And man, just doing this all on the top of your head just isn't going to work. It could be disastrous. And I recently did a video on Alibaba where I thought I was profitable. I thought I was really profitable. Turns out I'm only up 5% on that trade after owning it for a full year. And I'm not even up now. The stock has fallen during this recent sell-off. So you got to have your numbers in front of you. So you could buy back, you could buy more shares. You can sell cash secure puts with added money. So instead of buying shares, right? You don't want to take on that you don't want to take on that liability of owning more shares. You can write a cash secure put. Now, there's a couple ways of doing this. A couple ways of doing this. I do apologize. I'm just free rolling right now. You have to give me a little bit of runway. And if this is getting you, go get yourself a refresher on the coffee. Pause the podcast. You can do this with a cash secure put. So you got some extra money. Well, this is what I love to do. And I've done this many times. You know, the markets are crashing. So these high volatile, high quality stocks are being sold off. We talked about Facebook earlier falling 20 points. I'm going to tell you right now, because I've done this before. I guarantee an at the money 30-day cash secure put on Facebook would have gotten you some 14 points. So that is a great opportunity to find that support level that you're feeling good. You're feeling that you want to own the shares. And then you sell that cash secure put, picking up the fat premium. And now as the stock rebounds and starts to head higher, that $14 starts to shrink. And now when it starts to shrink, it's shrinking in big numbers. It's not shrinking in 50 cent here, 50 cent there. I did this on Adobe where Adobe fell some 20 points. I picked up at the money cash secure put. I got paid 14 bucks. I timed it perfectly. The markets went higher. It wasn't but a day later, I could have bought that cash secure put back for some $7. So there's opportunity. But again, I don't want you doing that willy-nilly because you could get stuck with those shares, right? Shit, had I done that with Alibaba at 187, and in fact I did, now thinking about it, I wrote a 185 cash secure put and Alibaba fell all the way down to 149. And I got assigned early. I did a podcast on that. Go to the website. I got assigned early. It was like 3 weeks early. That actually surprised me. Didn't shock me. I mean, I get it. The stock's trading at 149. This guy's got me on the hook for 185. They took it. Remember, they're buying insurance. You know, so again, you know, nothing is safe in this market. But hey, if you have your exit strategy in place, you understand what you're doing, you can benefit from it. And you can benefit from it less risky. Because let me say this about the TQs, and then I'll finish this up. If the TQs, I get $9 for that 5-month cash secure put. Now, if you go to YouTube and YouTube the risk of owning a leveraged ETF, oh man, you're going to get more videos scaring you about owning an ETF, a leveraged ETF, about how it's a depreciating asset. And here's a guy out there that has a video where, you know, he literally shows you losing half your investment, which I still don't understand. I have to watch that again because I have been watching the TQs and UDAO for the past 2 years now, and it mirrors the movement in the Dow and the NASDAQ. So I'm really going to have to dig into that because the TQs and the UDAO move 3% or 3x. And I totally get the whole idea that the price reboots and they gotta reboot the daily, right? The daily reload on. I get all that. But again, it moves 3%. It was down 9% yesterday. The NASDAQ was down 3%. So if it's up 3% today, it'll be up 9%. So I'm not saying it moves 1 for 1, but I don't see how you lose half your money. Anyway, with that said, I sold that cash secure put. So I don't own the risk of owning the TQs for the next 5 months. What I own is a $9 fat premium. And if by chance I get stuck owning the TQs at 55, well, that means, that means the NASDAQ hasn't moved from right here, right now. And my take is that the TQs, if anything, would finish near that 51 mark, which means the NASDAQ would be near the lows of the year. But again, I just have a feeling that it's going to go higher. So that's what I did. But again, I profited from it. That $5,500 sits on the sideline, making 17% while it sits there. Now, if I get assigned the TQs, what are we going to do? We're not going to sit on our hands. We will write a covered call once we get assigned the shares, and we'll be looking to make more premium. Now, hey, look, there's a lot right there. I hope some of it interests you. I hope it excited you to watch more videos, to learn this strategy, get excited, get motivated, so you'll get your financial education, and quite frankly, you'll do the strategies, and you will be able to profit from it. And that's really what it's all about. I'm going to leave it right there. I'm going to wish you all the best in trading. And look, when I get back from my travels, I'm going to be doing another red hot covered call video. So I want you to subscribe and bang that like button if you like what you heard today. Hey, look, until next time, may all your covered calls be profitable.